With all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say, really. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Woo! Baby, one of my favorite dividend ETFs, SCHD, just recently updated their top 10 holdings. I'd like to review those with you. We got Steve Eisman from The Big Short, who's shorting part of the real estate market, mentioned some of the Canadian US banking stocks. I'd love to talk about that, along with the semiconductor industry, my biggest bet of the year in January, putting $30,000+ in Taiwan semiconductors. We're seeing those stocks blow up right now. We're going to bring all of that into a nice rounded conversation. If you'd like that, hit that like button, folks, because it's what I enjoy talking about. But obviously, first and foremost, we saw the interest rates go up by 0.25 basis points today. The Fed obviously stating, we don't know if we're heading for a soft landing or not. There's still a lot of fear in the market, and I pray to God that fear bakes in. I want things to go back to bearish, baby. I love loading up. The window of opportunity for us young people needs to last for a bit longer. I know we all want to get rich tomorrow, but we ain't going to get rich without buying the discounts, which is why I keep telling you guys to take great advantage of the major dips, right? Because I don't know if we're ever going to revisit the October lows, where I made a joke that the market may have bottomed in the S&P, but it doesn't look like we're heading back there right now. So I'm kind of annoyed, and I'm only taking advantage of the dips when they happen. As I mentioned, every time they dip, I'm telling you guys, investing a few thousand, 10,000, whenever I get it, I'm buying these lows. But getting into SCHD, one that I will be buying next, I'll probably put 8,000 to 10,000 in this ETF in the coming couple of weeks as soon as my taxes get finished up. Tax advantaged account, contribution room, baby, what I'm living for. And this sucker is actually getting pretty close to those October lows. It's only trading off by about 6-7%, and this is a really good area to be cost averaging into this. Now, this is probably one of the most renowned, best performing, favorited amongst the dividend community kind of ETFs. Obviously, one of the most popular dividend ETFs in the business, the Schwab US Dividend Equity ETF, just completed its annual reconstitution. This is always an interesting event to watch because it's a multi-tiered stock selection approach that can lead to above average turnover. Funds such as the Vanguard Dividend Appreciation ETF or the Vanguard High Dividend Yield ETF, like VYM here, can focus more on long-term dividend growth streaks or high yields. Because they don't change a whole lot, the composition tends to not change much either. SCHD approach can shuffle names in and out of the portfolio regularly if the profile changes. And this is kind of what we want. It's kind of like a passive yet actively managed fund. But let's just take a look at some of the new holdings, because the Twitter account actually did a much better job. They removed a lot. They got rid of IBM, CMI, PRU, CP or GPC, HIG, like a lot of companies maybe most people don't know. But taking a look at what they added to the top 10 list here, it's making my mouth drool, baby. Let's get into this by actually just taking a look at the profile and the portfolio holdings on their website. So we can see AbbVie is now the top holding. We got Cisco, Pepsi, man, I love me some Pepsi, United Parcel Services, Pfizer, Texas Instrument, Broadcom. Verizon is one that I kind of have mixed feelings about, but we got Coca-Cola, Home Depot. These are like some of the most world-renowned dividend stocks. The combined portfolio is yielding like, I think, around 3.5+%. We can see sector exposures: information technology 21%, financials at 20%, consumer staples at 14%. We noticed that Lockheed Martin's not in here anymore, probably because it's become pretty expensive, I think, of a stock. It's just nice to see the management see what they take into consideration as value here, because I don't know if I would say Pepsi's trading in a fair value, but nonetheless, I love these companies, and they're companies I would continue to cost average into for the rest of my retirement. So I do appreciate what they're doing here, and I do like these holdings. But getting into it, Steve Eisman, I shared this video actually within my my patron members, which you could become a patron member, link down below. Get into my private WhatsApp group, $5 a month, less than a Starbucks coffee. But Steve Eisman here did an incredible insight into the banking sector, saying it's not like 2008. He said, yeah, there's going to be some small issues, but nothing that's going to have ramifications across the entire financial sector. But he said one of the areas that he's shorting, he wouldn't mention specific stocks, has been related to office REITs.
Access to capital because of tighter.
I don't want to talk about individual shorts.
Sure. Okay.
Do I think the banking sector is still a short? Well, it's imploded. So, would you want to short some of the bank stocks after some of them are down 60, 70%? Got to have a lot of guts to do that. Probably better just to mostly stay away. Do I think commercial real estate, well, not commercial real estate, office real estate is going to be a problem? Yeah, we do. We think office real estate, but the way these things unfold, it takes a long time. It really depends on each company when their debt rolls over. If somebody bought that building 2 years ago with, with long-term debt at 3%.
Right.
And let's say it's 5-year paper, and in 5 years it's going to roll over and it's going to be 7%. That's not good.
Sent some tremors down my spine because I'm seeing that with office REITs like True North Commercial. I mean, this thing just fell off an utter cliff thanks to some recent filings of them having to sell properties. Obviously, the interest raising environment is going to start to pressure some of these companies. And Steve Eisman alluded to this by saying if you can look into some companies that already are having tenant struggles, that have leases or mortgage terms that are coming up for renewal, they could get absolutely slaughtered in this high interest rate environment. And it's why I've been very cautiously watching REITs. We're seeing RioCan now back below $20 a share. I think it's a good buying opportunity here, but you got to pay attention and understand, I don't think we're ever going back to the lower interest rates we previously had. So you have to do a little bit of math and take a look at when most of these REITs have their renewals on their mortgages come up and run a bit of math on where the interest rate is likely to be by then. Because so let's say RioCan or something like Cap REIT, most of their renewals are coming up in 5 years. Well, you're gonna have to run the math on the cash flow, minusing out whatever the interest rate's gonna be on that, and obviously it's gonna be a hindrance to some of the growth here. So some stuff to pay attention to if you're interested in REITs, because we're seeing a lot of them pull back, which could lead into some favorable dip buys here as well. And again, I'm always analyzing these and just keeping them an eye on them. But man, some interesting stuff when interest rates go up. But talking about Taiwan Semiconductors, NVIDIA here. So I put a substantial amount of money in TSM at the beginning of the year. In fact, it's the only largest single stock position I've ever made in my entire career. And a lot of people keep asking me why not Apple? Why not these other companies? And it's just because I think there's best bang for my buck. I haven't seen value like this. It's nice to see a dividend yield around 2%, while the growth vector here is bar none way higher than anything we're seeing out of the mega caps in the US. I mean, this company is just resilient. They're still growing by 10 to 15% on a revenue basis. And I think they have margin control because there's no one competing with them. They're selling their higher end chips to things like NVIDIA that NVIDIA just announced they need more higher end chips. So NVIDIA stock is up 117%. If I was smarter, I should have just overpaid for NVIDIA because I could have doubled my money pretty much, since January. How high is it up since January? Yeah, I'd almost have doubled my money. Whereas with TSM, I'm only up, I bought this back in January around $75 a share, and I'm up 20 to 30%. So I'm hoping we get some more room to run here. If this thing does come back into its fair value range, which for me would be between 125, maybe 150, that's where I'll probably start trimming some shares in this. Again, not financial advice. I just think these things are way too undervalued for the current performance in this recessionary environment. Again, I'd like to hold some of this stuff long term, but again, I'm more of an index ETF focused, and I'm using these to outperform the market. So a lot of people said, how are you going to outperform the market, Kyle, if you're just buying indexes? Well, by hand selecting some individual stocks. And thanks to TSM, I'm not really down as much as I would be if I just held the indexes or something like SCHD. But again, there's exposed risk with this, and that could eventually bite me in the ass. And if you want to see how that turns out, consider subscribing for those future updates. But I will pass the question off to you at this point. I'd love to know what you guys think about the Fed, SCHD, other dividend ETFs. What are you buying? How do you feel about the bear market? Because I'm loving it, baby. Not buying McDonald's, but it's also done very well. I'll catch you in the next one.